Fanny, please join me on the stage to talk about parametric insurance. So, Fanny, you're technical parametric underwriter at Generali. Generali's involved in parametric insurance. You've got one of the larger parametric books out there. And there are more corporates that are choosing to use parametric insurance for certain risks. But for those who aren't familiar with it, can you explain what is parametric?
Sure. I think the best way to describe parametric insurance is we're covering the probability of some sort of event, whether that be NatCat or cyber or weather, as opposed to covering any sort of loss or damage to a specific asset or insurable asset. So it's really simple. We really only need kind of three things. That would be a parametric index, so that measures the event, or sorry, not the event, but the peril that's most dangerous to an insured's assets. We need a payout structure so that when that event is triggered, we know how much to pay out. And then, of course, we need that trigger level. So we set that depending on how exposed to that risk a client is. And so if an event reaches that trigger level, we can issue a payout really fast because that's all sort of decided at the inception of the policy as opposed to after an event has happened.
And what types of perils or events are most commonly covered by parametric?
Right. So traditionally, it's been mainly NatCat and weather-related perils, although as data and technology progresses, we're seeing more and more interesting types. So, cyber is really big. Pandemic is growing as well. But I would say the kind of bread and butter of parametrics is any sort of NatCat event and weather event.
We'll talk about some of those more exciting examples in a second, but natural catastrophe is probably the biggest part of the parametric insurance market.
Yeah.
What is it that's driving risk managers to turn to parametric?
I think there's a couple things, but if we're talking NatCat specifically, I guess, cyclone is the best example. In the kind of North American Atlantic hurricane season, a lot of companies are not able to find traditional coverage for named windstorms nowadays. It's just getting really expensive, and they're coming so much more with climate change. And so clients are looking for alternative solutions, and parametrics is a really, really great option for them to turn to. So that's kind of one of the
Yeah, and I imagine at Generali, I know you're insuring a lot of large corporates with traditional insurance products, property insurance. How does parametrics fit alongside that? Are there any examples you can give?
Sure, yeah. So one that we have that we like to talk a lot about, and they're great partners with us, are Northern Ireland Water. They've been in the sort of parametric space for, at least over 5 years now. And we do a lot of insurance with them on the property side and also parametrics. So we can use parametrics to cover very specific locations and weather events that might be missed in the sort of kind of blanket property program they have in place. So, we can do a freeze thaw or we can do excess heat with them. And those are very specific weather events to maybe Northern Ireland that they wouldn't necessarily get any coverage for, but they're events that happen enough that it's causing cash flow, it's causing issues with getting water to, their people in Northern Ireland. So.
And it's good examples because people often associate parametric with cyclones, hurricanes, earthquakes. That's something a bit different. And we're actually going to bring up a poll now because it's given a sense of that some of the interesting examples of parametric insurance being used. We've put up here some examples of parametric policies. So I would like the audience to decide which ones are real and which ones are not. Parametric insurance policies Generali is issued, and you can vote for multiple options. Scan the QR code and you can see what you think.
All of them already.
While people are still voting, Fanny, I mean, why are some of these interesting examples coming to you, and how are you able to deal with stuff that's not quite as repetitive as earthquakes and hurricanes, which you must get a lot of?
Yeah, so part of it is we work with our really great partners over at Descartes. They're super imaginative and creative with creating different parametric indexes, and that's how we're able to, have a lot of different opportunities and the clients coming to us looking for interesting coverage. And so The nice thing about parametrics is that we don't need to insure specific damage to a specific property or a specific insurable asset. So that makes it really easy for us to do supply chain, business interruption, beach seaweed clear up, like just anything that could potentially, anything that could potentially result in a loss of revenue or a loss of income to a client. And there's a lot of different businesses, there's a lot of different industries out there that might have some crazy losses or crazy reasons why they're, losing money. So it's a really great way to use a parametric index and the insurance market to find coverage.
And now people have voted, a lot of people believe that you can cover a sports event for lost revenue when it rains or a supplier against Rhine water levels. People are less convinced that you can insure beaches against seaweed. Tell us, what's the real answer? How many of these are real?
So we've seen inquiries and quotes for all 4 of these, actually. And if that's surprising, it should be. It's surprising to us to see it, but also really cool. I would say the 2 that are most popular are the 2 more common types of policies that we could issue, and they're the ones that we see most come in, and we're seeing more and more of them.
There was a lot of conversation in the first half about supply chains.
Yes.
Talk me through a couple of those examples we've got on the screen there and how it works.
So I think the best one is the sports event, where they rely on a lot of sales on the day of the sporting event, and it creates a lot of revenue for them, and that's really important revenue to them. And if they have too much rain, then obviously people don't want to go to the sporting event, and so they lose a lot of money, which no company really likes to do, especially very large sporting events. So we have renewed a couple years. They're quite happy with the product that we've come up with, and it takes the amount of rainfall in a certain given hours on the day of the event. And we also do one day before and one day after, because sporting events can go on for a couple of days. And so depending on the sort of millimeters of rain in a certain time period, we will then issue a parametric payout if those water levels are met.
That's a really important point, because for any parametric insurance policy, you need to know that you're measuring the right thing that's going to closely correlate with what the loss the client will experience. So talk me through some of that. People couldn't quite understand how seaweed coverage would work. How do you manage that?
Yeah.
What do you measure?
So I'm not sure if that one actually bound, but that one, the index was based on the amount of seaweed on a beach. So it was for a luxury hotel resort. And obviously, if they have a private beach, they can charge people money for drinks, just staying on the beach, any sporting activities that might be provided on the beach for them. And if they had tons and tons of seaweed, I mean that literally and figuratively, that would detract hotel guests from going to the beach, and so they would lose out on money. And so that index was based on, if the staff woke up one day and saw that there was a ton of seaweed, it had to reach, certain, I think, weight of it. And if those certain parameters were met, then a parametric payout would have been issued. So.
And there are a few examples there, about supply chains, about suppliers that might be in a different part of the world. Do you see a lot of inquiries about that? And why is parametric well suited to something like an earthquake in Taiwan?
Yeah, so that one's a really cool example, and we really like talking about it. That was a Norwegian company that builds semiconductors, and they rely on some chips that are made in Taiwan. I believe in Taiwan there's 2 factory plants that kind of manufacture most of these chips that we see in the world. And this Norwegian company knew that if they did not have these chips, it would cause a huge delay in their supply chain. And so what they decided to do was buy parametric coverage in Taiwan for earthquake, because that's one of the main hazards that affected the factories. And so if an earthquake were to strike there, then this Norwegian company would have gotten a parametric payout depending on how severe the earthquake was. And so that was a way of doing supply chain coverage for a company that didn't have any actual physical risk in Taiwan.
Yeah, so the earthquake wouldn't actually have damaged any of the assets necessarily.
No.
But you couldn't do business if you were receiving the chips.
Yeah.
So why is parametric well suited? Why aren't there traditional insurance is leaving some gaps, I suppose.
So I think traditional insurance is obviously really good and really successful in a lot of ways, but it's not as customizable as maybe we're needing moving forward. Especially as climate change is becoming more and more of an issue, we can do really specific tailor-made insurance programs on a small scale for one location or larger scale if you have properties or assets or anything insurable all over. It just sort of depends on our data quality, and we're seeing data get better and better as time moves on. And so that means we're able to build better products and more bespoke that are going to capture the risk that a client is actually seeing, as opposed to a sort of blanket property program or blanket insurance program that is meant to cover a whole lot of risks for a whole different myriad of events or companies, where there's not a lot of flexibility within the pricing.
And another difference with traditional insurance is how the actual claims process works, which is the product people are paying for. So tell me, what does a parametric claim look like?
So it's pretty simple for the most part. The idea is that before a client signs the insurance policy, they know how much money they'll be receiving in the event that some sort of weather or NatCat phenomena happens. And so what that means is that everything is set up in the policy beforehand, and all we require from the client is a proof of loss statement that shows they somehow lost revenue, money, had to shut down their business, or we're not seeing guests in, and so therefore we're not turning a profit. Anything like that. We just need to see a proof of loss. We'll cross-reference it with all of our data and monitoring systems in place to ensure that the event actually happened. And once those have been checked, we can issue a payout usually within 5 to 15 business days. And that's a lot quicker than a traditional property program. So that's a really great selling aspect for clients. It's kind of like getting really quick cash flow so that they can continue on their business, they can pay out staff, they can start to repair their buildings if that's the issues that they're having. So it's a really great way to get some cash flow back into the insured's pocket, really.
Risk managers in the room who haven't considered parametric before, or maybe they've considered it for some use cases, but there might be more out there. What would you advise them? Where should they start? Where might parametric be able to help in areas they're struggling at the moment?
I think that's a really good question. If they maybe have one particular risk or one particular client that is struggling to fit into a traditional program, that could be potentially scaled up, that would be something really interesting to look at. Starting with a pilot program and not expecting it to go sort of full scale all the way. I think that can be really daunting to risk managers and clients to take a whole program and shift it over to parametrics without doing a tester to see how it works for a year or two. And so just a bit of a slower transition, and then, really seeing if a parametric product is beneficial to them and their risk. And if it doesn't, is there anything else parametric-wise we can do? Is there a different peril? Is there a different structure that we can, offer to try and work with them and see if it's going to be the right solution for them?
I suppose it works quite closely with what they've got covered in their traditional insurance. Yeah. If there's a high deductible or there's just something that's excluded.
Yeah, so that's the nice thing about parametrics is we can sort of, do a deductible buyback scheme, and instead of the client taking that on, we can then have that as a parametric solution instead. We can do a NatCat or a weather carve-out, or, we can sit on a higher excess layer and sort of, help fill capacity if that's what they're looking for. So it's very flexible in those ways as well.
We've got time for a couple of questions from the audience. Does anyone like to? Yeah, we've got one at the front here.
Thank you. It's just a question around parametric insurance and climate change, and how much impact do you think climate change will have on parametric cover?
I think the nice thing about parametric cover is we're using kind of the most recent data. And so I know when I get a risk assessment sheet in, they always have some sort of, if it's related to climate, they'll usually have some sort of note about climate change or ENSO conditions affecting the deal or, our portfolio, or if the pricing is really high or really low, if there's climate change factors affecting those. So we're taking those into consideration pretty much for every deal. And I know the work that Descartes' doing with their models usually takes into account climate change because it is such a huge factor that's really driving our prices in the traditional property market.
One more question, if there is one. There's one right at the back.
So just a question around the data sets that you're using. In the examples that you had up there, I think, there was a mix of weather and nat cat. But let's take the seaweed one as an example. What type of requirements do you have to take on new data sets?
So that's a really good question. We tend to go through a screening process, and I say we, we'll work very closely with Descartes, who are our partners doing most of the modeling and sort of, data resourcing for us. And there's a very rigorous process to ensure that the data we're using is of the highest standards. And, sometimes we'll see on renewals that the data they're getting from the previous year is no longer as accurate as it was, or something happened with the stations, or they're not getting clear readings. And so, the next year we look into using a different data source. So it's a pretty rigorous process and always monitored because we know that parametric policy relies so heavily on that data source.
Thank you.
Thanks very much, Fanny.
Thank you.